what are the implications then for bonds in sort of this deflationary outlook, but also with sort of a rising rates backdrop? Like, what wins in that?
Yeah, it's bear flat.
Sorry, Adam, I think you're muted, Adam.
Yeah, pricing in inflation and pricing in deflation seems like a really interesting story. Like, how often do we see that historically, and what does that market environment typically look like in terms of where stocks and bonds go?
Yeah, so it's the difference between inflation and deflation is not much in terms of asset market performance. Like if you look at so we back tested everything through the lens of those grid regimes, and the reality is when you're on the right side of the chart, that means growth's decelerating. On the left side of the chart, that means growth's accelerating. And you sort of look at like what happens in equity style factor terms. It's pretty much the same. Same thing with fixed income. The only thing the only big pivots in fixed income is like, okay, I'm going to be long something like MBS as opposed to TIPS, or I'm going to be long, so I can actually get long the short end of the curve as opposed to IG credit or something like that. And so, the reality is, so inflation, a lot of folks associate, kind of stagflation with, okay, I got to go buy every commodity in sight, or I got to go buy this. But there's a reality to it that you typically only get paid in energy and food when you're in a growth slowing environment and inflation accelerating. This is the inflation environment that gets you paid in everything, commodities, everything, crypto, every inflation trade or inflation narrative that you want to put out there. When you cross this Rubicon of growth, things start to get weird. And the reason they get weird is because you're slowing. And the slowdown of growth, reduces investors' willingness to take risk, reduces businesses' willingness to take risk. And then obviously it creates a much more higher volatility environment. If you look at something like our back test for the S&P, for example, you look at the volatility is around 11 or 12 when you're in Goldilocks or inflation, but you're somewhere between 15 to 20 on average when you're in inflation and deflation. And that's pretty consistent across all risk assets.
I imagine if you added the balanced portfolio, sort of the 60-40 is the predominant way that investors would view that, it's not much better. Does the correlation between sort of the government bonds and equities rise a little bit in that scenario, or not?
Yeah, the inverse correlation tends to pick up whenever you have growth slowing. So that typically is what I mean. That's obviously what's happened in the last week or so. Last week over week. Mm-hmm. I mean, bonds have had a massive move higher as a function of these dynamics, in our opinion, changing. I mean, it's all reflexive, right? Bonds having a massive move higher is contributing to the nowcast for inflation and deflation rising. And the only reason that inflation and deflation are they're all rising as a function of risk assets selling off. But the fact that you still have some latent bullish signals in commodity space are keeping inflation well bid for now as a market regime. But certainly if we continue down this path, that'll be that'll end pretty quickly.